What's going on, investors? It's AK from Fallible, and today we are going to do some more learning about options. In this video, we're going to see how commissions can get so screwed up when you're dealing with these things. And we're going to show you why you need to be careful. But before we get into it, if you haven't already, make sure you sign up for this options trading guide. It goes deep in options. It's going to teach you the stuff that everyone should know who are trading options, but they don't know. And that's why they're suckers. Because options just aren't about making directional bets. It's a lot to do with volatility and time decay and stuff like that. If you don't know what I'm talking about, or if you do kind of know what I'm talking about, either way, go sign up for this guide. I'll put the link up above in this video and down below in the description and comments. Click that page, put in your email, and I'll send this to you for free. This is what taught me a lot about options that I didn't know. My buddy Tyler from MacroOps wrote it. Tyler also wrote this article, The Misconceptions and Pitfalls of Options Trading, which I'll link to also. And one of the big pitfalls is commission intensity. So remember in the last video, we talked about all the different spreads there are and how excited people get, even though they're stupid most of the time. You know, vertical spreads, iron condors, butterflies, iron butterflies, straddles, strangles, you know, those BDSM type option plays. Oh, collars too, of course. Spiked collars, I assume. But anyway, with all those spreads, the thing that happens is that they just run up your commissions, at least if you're a retail trader. So the primary goal of a spread is to hedge or reduce your exposure. You're not really trying to add anything new to your book with this strategy. But novice traders don't really understand that. They're out here trying to place bets with spreads. So what Tyler is saying here is that most professionals are using these types of spread plays to hedge out the exposure in their portfolio. So they're not just placing one spread bet. That spread bet fits into their entire portfolio construction. And from that point of view, the commissions and how it works might make more sense versus someone trying to do a standalone play with one spread. It's just not used to make a directional bet as much, by professionals anyway. So the other problem is that when retail traders get their hands on these spreads, they start getting eaten alive by the commissions. So Tyler gives an example of a bull call spread. So that's basically when you buy one call at a certain strike price and then sell another call at a higher strike price. So buying the first call gives you exposure to the underlying price of the stock going up, but selling the second call gives you exposure to the underlying price going down. And obviously these two positions clearly contradict themselves if you're trying to bet on direction. So consider a 208-210 call spread in SPY. The 208 call is trading for 325 and the 210 call is trading for 218. So you can buy the 208 call and sell the 210 call for a net debit of 107. So the 208 call costs 325, right? Then when you sell the 210 call, you get that 218. So when you add that together, really what you're paying in total is that 107. So the maximum total value this spread can reach is $2. And that's the width between the two strikes of 210 and 208. You're trying to get it in that little zone. The maximum amount of profit you could make on this trade is that $2 minus the 107, which again, $2 is the maximum profit, 107 is the net what you paid for it. Then you multiply that by 100 because, you know, it's the options contract and you get $93. And the max you can lose is that 107 you paid, which is the cost of the spread. So max profit 93, max loss 107. Are you following? I know it's a lot of numbers. If you're better at reading numbers, then I'm going to put a link to this article anyway, you can check it out. But who doesn't love numbers being read at them, right? Let's continue. So since a vertical spread consists of two options, you have to purchase two contracts to complete the trade. So if you have a standard commission rate of $1 per contract, that would cost you $2 in total, right? So $1 for the first contract and $1 for the second contract, $2 total. But spending that $2 in fees to make $93 is horrible. Now this is kind of hard to see unless you run a cycle. So let's say the win rate on this trade is 60%. So with that win rate, you can calculate the break-even rate, which is 53.5%, and you can calculate your edge, which is 6.5%. If you don't understand that, that's okay. It's not really pertinent to this example. Tyler just uses that edge right here to show you what a cycle could look like of 10 trades. So he goes through the example. Okay, first trade, you lose 107. Second, you win 93. Third, you lose, you win on the fourth, and then, you know, so on and so forth. And eventually you tally it all up and your total profits from that string of trades is 558. Total losses, 428. So with that 6.5% edge, you made $130. But guess what? Along the way, you also had to pay $2 for every trade because it was $1 to buy the call and $1 to sell the call, right? To make the spread. And then 2 times 10 is $20. So $20 total is what you paid across these 10 trades. So your profit drops to 110. So commissions ended up cutting over 15% from your bottom line. And that's with a cheap commission structure and a strong edge. And you were assuming that you let the spread expire. Because if you had to exit that spread before it expired, well, then you'd rack up another $2 per trade. Because you paid $2 just to enter that spread, then it's another $2 to exit. So then your total commission cost would be $40. That leaves you with a net profit of only 90, which means 30% of your profits were cut from your bottom line just through commissions. So these commissions really add up, and the economics get even worse as you tighten the option spread, meaning you use strikes closer together or add more legs. And a leg just refers to one part of the spread. So he says some option spreads require 4 legs to execute, which means that instead of just buying 2 calls to execute the spread, you're buying 4. So you can see how your commissions just keep adding up if you're doing something like that. So Tyler's point is that you could spend far less in commissions on a futures contract or outright stock for a much larger upside. When with this stupid spread, I mean your max profit was $2. Now obviously the strategy in this example is still profitable. And it's true you could run this and still be profitable, but not as profitable as you could be. And honestly, most people aren't even thinking about the commissions and how much of a percentage they bring down the total profit. So the moral of the story is that you need to be careful when you're building all these complicated option spreads. You need to look at what the commissions are costing you. And the brokerage isn't going to tell you. I mean, they're fine with it, right? Because they're making all that money the more complicated you get. So when it comes to options, watch those commissions. And like we said before, most of these spreads aren't that useful in the first place because these spreads are used to hedge a portfolio where people who don't know what they're doing, they're trying to use the spreads to make a directional bet. It doesn't make sense. And if you want to know more about why using options to make directional bets in general is kind of tough, you got to sign up for this report that I mentioned before because it will teach you all about how big of a deal volatility plays in options trading. Definitely sign up for that. Now we've got more stuff to talk about when it comes to options, and those videos are going to keep coming out. So if you haven't already, subscribe to this channel and hit that notification bell so you get an email notification when those videos come out. We're publishing every single day about markets and business. It's not just options. We've got a lot of options for content, but hit subscribe and I will see you in the next video. Stay fallible out there. Bye.